Picture this. You've worked for 35 years and paid into Social Security your whole career. The month you finally retire, you sit down to figure out your budget, and your Social Security check is bigger than you expected. That feels great, but then tax season rolls around and your accountant calls. She says, "I need to talk to you about your Social Security income," and suddenly the good feeling fades. Turns out a portion of your benefits is taxable. Not a little, but a significant chunk. And the worst part is that nobody warned you. Nobody explained the formula, and you didn't do anything wrong. You just didn't know the rule existed. And today, we're going to fix that. Because there is a specific income formula the IRS uses to decide whether your Social Security benefits get taxed. It works completely differently from any income calculation you've probably ever seen before, and it counts things most people don't expect. The thresholds inside that formula haven't moved in over 40 years. Not once, not for inflation, not for anything. So every year, quietly and invisibly, more and more retirees cross into taxable territory without realizing it. Not because their situation changed dramatically, but because the math finally caught up with them. By the end of this video, you're going to understand 5 specific things that can change how you plan. First, the exact formula the IRS uses explained in plain English so anyone can follow it. Second, why so many retirees get surprised by this, even when they think they've planned carefully. Third, the hidden income sources that count toward the formula that most people don't realize are included. Fourth, what actually changed and what did not change with the new 2025 tax law? That law got a lot of press about no tax on Social Security, and we need to set the record straight. Fifth, a simple framework you can use right now at the kitchen table to start thinking about where you stand. Stick around to the end because I'm going to give you a step-by-step framework called the Combined Income Check. It will help you have a much smarter conversation with your tax professional or financial planner. You don't have to figure all of this out alone, but you do need to understand the basics. And after today, you will hear something that puts this whole issue in perspective and explains why it matters so much right now. In 1984, the first year Social Security benefits could be taxed at all, fewer than 1 in 10 recipients paid any federal income tax on their benefits. Fewer than 10%, and that sounds pretty manageable. Fast forward to today, and the Social Security Administration's own research models project that roughly 56% of Social Security beneficiary families will owe federal income tax on their benefits over the coming decades. More than half, and that number is growing. Not because Congress passed a law raising taxes on retirees. It's growing because the income thresholds that trigger taxation have been frozen in place since 1983 and 1993. Meanwhile, wages, benefits, and retirement account balances have kept rising with inflation every single year. Let me put that another way. The formula hasn't moved, but the finish line is in the same place it was 40 years ago. Everyone is getting closer to it, and most people don't know it's there. And here's where it gets especially important right now, because a lot of people saw news in 2025 about no tax on Social Security. It was connected to a new law signed on July 4th, and many people assumed the problem was solved. It wasn't, not entirely, and we're going to talk about what that law actually does in a few minutes. Understanding the difference between what changed and what didn't could save you from a real planning mistake. But first, let's make sure you understand the foundation, because the formula is actually simpler than it sounds once someone walks you through it. Let me explain this simply, and I want to start with an everyday picture before we get to any numbers. Think of it like a measuring cup. The IRS takes several different kinds of income and pours them all into the same measuring cup. Then it checks to see if the total crosses a certain line, and if it does, a portion of your Social Security benefits becomes taxable. The higher the total goes above that line, the more becomes taxable. But some of what gets poured in surprises almost everyone. The IRS calls this your combined income, and some advisors call it provisional income. It's calculated like this. You take your adjusted gross income, you add any tax-exempt interest you received, and then you add half of your Social Security benefits for the year. Add those three things together, and that's your combined income. That's the number that determines whether you owe taxes on your Social Security. Now here's how the thresholds work, and these are the official figures from IRS Publication 915. If you're a single filer and your combined income is below $25,000, none of your Social Security benefits are federally taxed. If your combined income is between $25,000 and $34,000, up to 50% of your benefits may become taxable. Cross $34,000 as a single filer, and up to 85% of your benefits can be taxed. For married couples filing jointly, those same tiers sit at $32,000 and $44,000. And no matter how high your income goes, the maximum that can ever be taxed is 85% of your benefits, never more than that. Those thresholds were set in 1983 for the lower tier and 1993 for the upper tier, and they have never been adjusted. Not for inflation, not for rising benefit amounts, not once in over 40 years. That's the foundation. And it's simple enough, but there are a few things hiding inside that formula that catch retirees completely off guard. That's exactly where we're going next, and I want to give each one a name so you can remember it. I want to walk you through 4 traps, and none of them are complicated, but all of them are common. Trap number 1 is what I call the municipal bond surprise, and this one catches a lot of careful savers off guard. A lot of retirees hold municipal bonds, specifically because the interest is tax-free at the federal level. And that's true, but here's what most people don't know. Tax-exempt municipal bond interest still counts toward your combined income formula for Social Security taxation purposes. It goes right into the measuring cup. So you could be sitting there thinking you've got tax-free income and you're being smart. Meanwhile, that income is quietly pushing your combined income number over the threshold and triggering taxes on your Social Security check. The income is tax-free in one calculation and counts against you in another at the exact same time, and that surprises almost everyone. Trap number 2 is the RMD ambush, and this one has a very specific birthday attached to it. When you turn 73, the IRS requires you to start taking distributions from your traditional IRA, traditional 401k, and similar pre-tax accounts. These are called required minimum distributions, and every dollar of those distributions goes directly into your adjusted gross income. That means every dollar goes directly into your combined income calculation. And for many retirees, the first year RMDs arrive is the year everything changes. Someone who had been comfortably below the threshold for years suddenly finds that one RMD has pushed them into the 85% zone. It can feel like it came out of nowhere. It didn't, the rule was always there, but nobody told them it was coming. Trap number 3 is what I call COLA creep, and this one is especially sneaky because it's disguised as good news. Each year, Social Security benefits get a cost of living adjustment based on inflation, and most retirees are genuinely glad to get it. But here's what happens inside the formula. Your benefits go up. And remember, half of your benefits go into the combined income calculation. So every cost of living adjustment automatically raises your combined income a little bit without you doing anything differently at all. For someone hovering just under the threshold, a 2 or 3% adjustment can be enough to push them over the line for the first time. It's not dramatic, it's a slow drift, but it's real, and it happens to a lot of people. Trap number 4 is the interest rate catch-up, and this one has become more relevant over the last several years. As interest rates on savings accounts and money market accounts rose significantly, That was genuinely good news for retirees holding cash. But that interest income goes into your adjusted gross income, which then goes into your combined income number. Retirees who parked money in high-yield savings or short-term certificates of deposit found that the very decision that helped them also quietly pushed their combined income higher. Higher rates meant higher interest income, which meant more of their Social Security potentially subject to taxation. Nobody's fault, just something to be aware of, and something a little planning can help you manage. Here's the reassuring part. Knowing these traps exist means you can plan around them, and that's exactly what we're going to do next. Let me show you what all of this actually looks like in real numbers, using a fictional couple who feels very real. Stop me if this sounds familiar, because I think a lot of you are going to see yourselves in Robert and Carol. Robert is 68 and Carol is 67, both retired, living in a mid-sized city, and they own their home outright. They've been pretty careful savers their whole lives, and they thought they had a pretty good handle on their retirement income. Robert collects $20,000 a year in Social Security, and Carol gets $8,000 for a combined annual benefit of $28,000. They also take $20,000 a year in distributions from Robert's traditional IRA to cover their living expenses and property taxes. And they keep some money in a municipal bond fund that pays them about $2,000 a year in interest. They chose those bonds specifically because they thought the interest was tax-free, and in the usual sense, it is. Now let's run their combined income calculation. And I want to be clear that this is a simplified illustration using the assumptions I just described. Real situations are always more nuanced, and your numbers will be different, so please treat this as an educational example only. Here's what goes into Robert and Carol's measuring cup. Their adjusted gross income is $20,000 from the IRA distribution. They add their $2,000 of tax-exempt municipal bond interest, because yes, it counts in this formula. And then they add half of their $28,000 Social Security benefit, which is $14,000. Their combined income comes to $36,000. And let's see where that lands on the threshold chart. As a married couple filing jointly, $36,000 is above the lower threshold of $32,000, but below the upper threshold of $44,000. That means up to 50% of their Social Security benefits may be taxable, which is up to $14,000 flowing into their taxable income. Now, let's imagine that over the next few years, a few ordinary things happen. All of them common and none of them dramatic. Robert's IRA generates larger required minimum distributions as the account balance has grown over time. Their Social Security gets cost of living increases each year, which is good, but it also nudges their combined income a little higher each time. Their savings account is earning more interest than it used to because rates have been higher. Their combined income drifts from $36,000 to over $44,000, and now they've crossed the upper threshold. Up to 85% of their $28,000 benefit could potentially be counted as taxable income. That's up to $23,800 of Social Security showing up in their taxable income calculation. They didn't do anything reckless, they didn't win the lottery, they just drifted, because the thresholds held still while their income moved forward. Here's the difference that a little planning could make. If they had understood this formula earlier in their retirement, they might have had conversations about the source and timing of their income, and those conversations can really matter. Maybe they explore whether some savings would have been better positioned in a Roth account in the years before retirement. Maybe they look at a qualified charitable distribution from the IRA once they hit 70 and a half. Maybe they simply understand what's happening, so it isn't a surprise when tax season comes, and that alone has real value. Understanding the formula doesn't mean everything is fixable, but it does mean you're not blindsided. And in retirement, surprises are usually expensive. Let's talk about what you can actually do, step by step, starting today. I want to give you a simple process you can start using right now, and I call it the combined income check. You don't need software for this, and you don't need an accounting degree. You need a piece of paper, a pen, and about 20 minutes. Step 1 is to gather your income sources, and I mean all of them, written down in one place. That means Social Security, pension income, wages from part-time work, traditional IRA or 401k distributions, interest income from savings accounts and certificates of deposit. Also write down dividend income, capital gains distributions, and any tax-exempt interest from municipal bonds or similar investments. Don't leave anything out at this stage, because you can always cross things off later once you see the full picture. Step 2 is to build your combined income number using the formula we walked through together earlier in this video. Take your adjusted gross income, which includes most of what you wrote down except Social Security itself, then add your tax-exempt interest. Then add exactly half of your annual Social Security benefit and write that total down, because that's your combined income. Step 3 is to check where you stand. And this is where the formula becomes personal and concrete for you. If you're filing as single or head of household, below $25,000 means none of your Social Security is federally taxable. Between $25,000 and $34,000 means up to 50% may be taxable. And above $34,000 means up to 85% may be taxable. If you're married filing jointly, those same tiers sit at $32,000 and $44,000. So check which zone you land in. Step 4 is to look at your income levers. And this is the most important step. And it's also the one you can start this week. Look at your income list and ask yourself which of these sources you can actually influence or adjust. You can't easily change your Social Security benefit amount once you're already collecting. But you may have choices about your IRA distributions. You may have options around the timing of withdrawals, the amounts you take each year, and in some cases, the form those withdrawals take. Just asking the question, which of my income sources are in my control, puts you ahead of most retirees. Step 5 is to bring your combined income check to a qualified professional, because this is where the process gets powerful. Take that sheet of paper to a fiduciary financial planner or a tax professional who understands retirement income. Show them your numbers and ask, given this combined income, how much of my Social Security is currently taxable? And what can we do? You will get a much better meeting if you walk in knowing what combined income means and where you stand. That framework, 5 steps, 1 piece of paper, 1 smart conversation, is the practical tool I promised you at the start. Now let me cover a few more advanced ideas that come up once you understand the foundation we've built together. Once you're clear on the basics, there are a few more advanced strategies worth knowing about, and I want to mention 3 of them. The first is Roth account withdrawals. And here's the key distinction that makes them so useful in retirement income planning. A Roth IRA or Roth 401k distribution does not count toward your combined income calculation because it's not included in your adjusted gross income. Retirees who have a mix of traditional and Roth savings have more flexibility to manage their combined income in any given year. By leaning on the Roth side when they need extra cash, they can potentially keep their combined income number lower and reduce taxes on their Social Security. If you're still working and making contributions, this is one reason many planners recommend building Roth savings before retirement, because that flexibility is real and it compounds. The second strategy is qualified charitable distributions, and this one is among the most underused planning tools in all of retirement. If you're 70 and a half or older, you can donate up to $100,000 per year directly from your IRA to a qualifying charity. That distribution goes straight to the charity and never passes through your income, which means it doesn't count toward your adjusted gross income. It doesn't increase your combined income, and if you're facing required minimum distributions, a qualified charitable distribution can satisfy part of that requirement while reducing your tax exposure. If you're already charitably inclined, this is worth asking your tax professional about because it's a strategy that benefits you and the causes you care about. The third involves the new 2025 senior deduction, and this deserves a careful explanation because a lot of people got the wrong idea from the news coverage. The One Big Beautiful Bill Act, signed into law on July 4th, 2025 as Public Law 119-21, created a new temporary additional deduction. The deduction is $6,000 for individuals age 65 and older, and married couples where both spouses qualify can claim $12,000 total. This deduction is available for tax years 2025 through 2028 only, and it begins to phase out above certain income levels. For single filers, the phase-out begins at $75,000 of modified adjusted gross income, and for joint filers, it begins at $150,000. The deduction is available whether you itemize your deductions or take the standard deduction, which makes it accessible for most retirees. Here's what it does. It reduces your overall taxable income, which can reduce your federal tax bill, and that is a real benefit for many retirees. But here's what it does not do, and this is the part that got lost in a lot of the news coverage. It does not change the combined income formula, it does not change the thresholds at which Social Security benefits become taxable, and Social Security is still potentially taxable. The underlying rules work exactly the same way they always have. The deduction helps your overall tax bill, but doesn't rewrite the formula. Understanding the combined income formula still matters, especially for planning beyond 2028, when this provision is currently set to expire, unless Congress acts. A tax professional who knows retirement income well can help you model how all of these tools interact in your specific situation. The strategies are real, the combinations are complex, and that's exactly what qualified planners and tax professionals are there to help you with. When a river floods, it doesn't do it all at once in a dramatic way that gives you plenty of time to react. It rises slowly, half an inch, then another half inch, and by the time most people notice it's in the living room, they wish they'd been watching sooner. The Social Security taxation formula is a little like that river because it doesn't announce itself, it just rises. A cost of living adjustment here, a higher savings rate there, a required minimum distribution that arrives right on schedule, and suddenly the water's at your door. Most of the retirees who get surprised by it weren't careless, they just didn't know where to look. And now you do. You know what combined income is, and exactly how it's calculated from 3 simple inputs. You know, the 4 traps that push people over the threshold without warning, the municipal bond surprise, the RMD ambush, COLA creep, and the interest rate catch-up. You know what the new 2025 deduction actually does? And just as importantly, what it doesn't do? And you have a 5-step combined income check you can start on your own and then bring to the right professional. This is not easy material. And I want to be honest with you about that, because even careful, lifelong savers find this formula confusing at first. That's not a character flaw. That's a system that was never designed to be easy to understand from the outside. The fact that you're here, learning it now, means you're ahead of the game, and that is genuinely worth something. One last thing, and this matters. Everything in this video is educational and designed to help you understand how the system works. It is not personal tax advice. It is not legal advice, and it is not investment advice, because your situation is unique. The right moves for Robert and Carol in our example may not be the right moves for you and your family. Please work with a qualified fiduciary financial planner and a licensed tax professional who know your complete financial picture before making any changes. If this video helped you see something more clearly today, leave the word "clear" in the comments below.
It really helps me understand what's landing for you.
It also helps other people find this content when they need it most, so your comment genuinely makes a difference. If you haven't subscribed to Uncle John Financial yet, now's a great time because we put out new retirement education every single week.
Always in plain English, always aimed at helping you feel more confident and more prepared for this chapter of your life.
Take care of yourselves. You've worked hard to get here, and you deserve to understand it.